Corporate Finance OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to the creation of financial statements including the balance sheet, the income statement, statement of retained earnings. We're going to be saving the cash flow statement for a future presentation. Get ready to take a stance with Corporate Finance. Here we are in OneNote. If you would like to follow along in OneNote, you're not required to do so, but if you have access and would like to, we're in the 237 Financial Statement Creations and the Practice Problem tab. Closing this back up, we're going to have our information up top. We're going to use this information to create the financial statements, that being the balance sheet, the income statement, and then the statement of retained earnings, which kind of links the two statements. The practice of doing this, we want to get a better understanding of the relationship between the balance sheet and the income statement because they both tie into the double entry accounting system. The income statement is related to the balance sheet, even though the income statement is showing performance, balance sheet is showing as of a point in time. They both feed into the double entry accounting system. So we want to get an understanding of that. To do so, we're not going to be building this thing from scratch again like we might do from a accounting perspective, but rather we're going to have the information, or we're going to be given the information, the listing of accounts, and then we'll go through and use this information to create the financial statements. Now, I'm not going to be going back up and referencing this information every time we look at an account in this problem in OneNote. We will do that in Excel, however. So and I highly recommend doing this problem and other problems in Excel, practicing your Excel skills as well as looking at this data, again, putting it together yourself. But here we'll take this data and we'll basically put it together in the financial statements and then review the financial statements, the balance sheet and income statement together. And then next time we'll take a look and we'll add the next financial statement, which will be the cash flow statement. Now notice if you were to do this in Excel, we've got on the income statement, we're going to have a lot of information that'll help us to basically calculate these items based on this information. Again, it's still somewhat, the data is just basically still kind of just given to you, unlike what we might do if we did it all from scratch, like we would do in an accounting course where we would do the financial transactions, make the general ledger, make the trial balance, and then use the trial balance to make the financial statements. We won't go through that much detail in a finance course because, again, you don't need as much detail. But if you do this in Excel, we'll give you some other calculations that'll hopefully make the links a little bit more clear in terms of the linking between the income statement and the balance sheet. Here, again, we're just going to kind of reveal the accounts and then talk about the relationship between them. So this is going to be our information up top. We got a snapshot of that information down below. So here's all the information for our practice problem. Now, when you build the financial statements, typically they say, most books will say you have to do the income statement before you do the statement of retained earnings and then the balance sheet. Why do you have to do it this way? Because when you think about the link between these three statements, which is what I want to focus in on here, the bottom line of the income statement is going to be the income here, right? The earnings after taxes, or if there's preferred dividends, we can look at the earnings available to the common stockholders. And then if we look at the statement of retained earnings, we're going to be using that earnings available to common stockholders to help calculate the ending retained earnings. And this ending retained earnings then is what is going to link the balance sheet and the income statement. This then will be found then on the balance sheet. So we'll need that number on the balance sheet down here to be going into the retained earnings, the 97,300, the 97,300. That's the link I want to basically focus in on. Now, in practice, it's kind of nice, like if you're in Excel or something like that and you're working this from a trial balance, you can actually do the balance sheet first because you can do that calculation in Excel fairly easily. And it's nice to look at the balance sheet because the balance sheet basically starts from top to bottom as we would visualize like a chart of accounts or a trial balance. It starts assets. I mean, we usually memorize the accounts in terms of starting with cash, right, which is an asset, then liabilities, then equity, then the income statement, income and expenses. So we build it. The recommendation is often that we're going to build this thing in reverse to how we kind of visualize it in practice, which is balance sheet accounts and then income statement accounts. And that's because of this linkage. So keep that in mind. We'll keep that tradition here. We're going to start off with the income statement using these numbers. This is the performance statement. We'll just kind of review the income statement. Then we'll create the statement of retained earnings. Then we'll create the balance sheet, and we'll be focusing in on the links between them. Again, I highly recommend doing this in Excel to practice Excel with relation to these items as well. So the income statement, once again, I'll go through this fairly quickly because we've looked at these two financial statements before. So I'll go through these a little bit more quickly and look at the links between them. If you want more detail on any individual statement, look at a prior presentation within it. So we have the income statement starts with income or revenue. So the term of it will be revenue, but it could be called income. It could be called sales. It could be called fees earned. If we sell things, inventory, then we'll have cost of goods sold representing the cost of that inventory that we are selling. We're going to have a subtotal then along the way, which is going to be gross profit, because the relationship between revenue and that expense of cost of goods sold is very important. Therefore, we create a subtotal to get on the way down to the ending number, which will be the net income. Then we have the selling and admin, recalling that the selling and admin are basically categories of expenses. You might have two different categories of expenses, selling expenses, which then could include expenses within that category, which would be things like the sales salary or the sales commission, anything that's related to the store that you sell stuff in. And then the admin expenses might be anything related to the corporate office, admin salaries, and so on. Then we got the depreciation expense that we have been breaking out in order for us to consider that difference between accrual and cash basis as we think about the statement of cash flows, which we'll do in a future presentation. We'll put together a full statement of cash flows. Then we have the operating profits, which is going to take the last pit stop we stopped on the way to net income, that being gross profit, subtracting out then selling and admin, and the depreciation to get to the operating profit, that then being the normal profit from the normal operations, from what we do, what the main things that we do. Then we're going to look at those things that might not be included in the operating profit, which may include interest expense, because we would only have interest expense if we were to have financing. So we're going to take the $50,100 minus the interest expense to get to the earnings before taxes. So earnings before taxes, we always have earnings before taxes because we have to have that earnings in order to calculate the taxes. Taxes often confuse our analysis because they go up as earnings go up. So they are something that we always break out. So then we got the taxes, which are going to be calculated based on the earnings at the $8,044. Then we're going to have the earnings after taxes, which is basically net income. It's basically our bottom line number, which is the $40,220 minus the $8,044 to get to the $32,176. Now, this is the bottom line basically of the income statement. However, you can use the income statement and tack on earnings per share calculation basically onto the bottom of the income statement. So we'll add on here then the preferred stock dividends that we're going to be paying out. So of these earnings then, the preferred stock gets paid first. So when we think about how much of that earnings should be applied to the common stockholders, who we think of as the actual owners, we're going to subtract out the preferred stock first. So that's going to be the $2,500 that we will subtract out. $32,176 minus the $2,500 gives us the amount that would be then available for the common stockholders of the $29,676. So then we're going to divide that by the shares outstanding. The shares outstanding do not represent the number of shareholders, but the number of shares. One shareholder may have multiple shares. These are standard unit, kind of like dollars are standard units that have value, that create value. These are standard units of ownership of the company. So the 29,676 divided by the shares outstanding, 10,000, gives us 297. This number could be rounded. Note, we're going to take it to 2 decimals, so 2.97 earning per share. But you're really concentrating in on, with regards to the financial statement creation, the bottom line of the income statement, that being the $32,176, and then this earnings available after the preferred stock, the $29,676. Then we're going to go to the statement of retained earnings. Now, the retained earnings, remember, on the balance sheet represents basically the amount, or let's say the retained earnings is part of equity on the balance sheet. And if you think about the accounting equation, assets equal liabilities plus equity, or assets minus liability equals equity, equity then is the owner's claim to the assets of the company, the claim of the owners to basically the assets of the company, as opposed to the claim of third parties to the assets of the company, which would be the liabilities. One major component of equity, we're going to break out equity from the investment to the investment that was put in place, the investment by the owners in the form of purchasing common stock and preferred stock, and then the earnings that have accumulated upwards, including the ones this year, which accumulated upwards, right? This 176 or the 29,676 after the preferred stock, right? We're going to include that into the retained earnings as well. So what we're going to do with the statement of retained earnings, because that's not the only thing that's going to be included in there, there's also going to be included in there possibly dividends. So retained earnings goes up with the income, retained earnings goes down with any distribution of that income to the owners in the form of dividends. So what we got to start with retained earnings then is the beginning retained earnings, meaning the $69,500 represents retained earnings that was on the balance sheet last year, meaning it was there. The ending number as of 12/31, December 31st last year is now the beginning number at the starting of this year, January 1st of the current year, 69,500. Because remember, the balance sheet is as of a point in time. So we're going to reconcile last point in time, last year, for retained earnings, and then have the change, record the change in retained earnings, which is going to include the net income, or if there was preferred stock, then we're taking the earnings available to the common stockholders, in this case, the $29,676, which we're getting from the income statement. So this is how the income statement is linking to the statement of retained earnings, which will then link to the balance sheet. The income statement, in other words, is kind of the story, the year's worth of activity that happened that got us to the point in time that we are at. It's kind of like if someone was running a race and someone's at the finish line, you got to go back and tell the story of them running the race. That's the story of them getting and how they got to the ending point, which is the finish line, right? So we're going to have that same thing here. This is our starting point. This is where we started. We increase then by the 29,676. Then we're going to decrease by the dividends. These are the dividends to the common stockholders of the 1,876. And that's going to give us then our ending retained earnings. So the statement of retained earnings, notice it's if you look at the income statement, we're starting for all these numbers are starting from zero. Just like if you're trying to see how many miles you can run in an hour, right? You're starting at zero and you're just going to count upwards until you get to how many miles, or maybe not whatever unit of measure you're going to use, right? How many yards you can run in an hour or whatever. You're going to be increasing from zero at your starting point and then go from there. That's what the income statement is doing. Every account here started from zero as of January and then went up from there. If you're thinking about the statement of retained earnings, you're trying to reconcile the point that you did start from before, which was the retained earnings as of the end of last year, and then adding to it however many yards you ran this time, or in this case, how many net income dollar units that you have accumulated upwards minus those that you paid out to the shareholders. So we're going to be taking then the 69,500 is what we had before, plus the 29,676 is what we earned, and then we're going to say minus what we paid out, 1,876 in dividends, and that means that we've got ending retained earnings. That's where we stand now, of 97,300. That's how much of retained earnings we have accumulated, which we have not yet distributed out as of the end of the time period, which is December 31st, typically, if it's a year-end financial statement we're looking at for a normal, calendar year end. So now let's consider our balance sheet, and our main concern on the balance sheet is going to be that equity section that we're going to tie out, because we could see, I'll just cheat down here. We'll open this up down here. Retained earnings, there's that 97,300. So that's where the relationship is between the income statement and the balance sheet. But let's just go through the whole thing again. Remember, the balance sheet is the accounting equation. So when you think about the double entry accounting system, it is the balance sheet. So we've been saying, hey, the balance sheet, assets equal liabilities plus equity. And then your question might have been, well, how does the income statement fit into that story? Because on the income statement, all I have are income and expenses. I see no assets. I see no liabilities. I see no equity. Well, the reason is what really happens is the whole income statement is a breakout of the story of equity, right? We're telling a story about a breakout of the equity section. This whole income statement then is being included in how we got to the ending balance of equity. So the income statement, you can think about it from an accounting equation standpoint, assets equal liabilities plus equity is basically part of equity, right? It's basically part of equity. We're just giving more detail about the story of that equity for performance measurements, but it's included, all the activity that's in there is basically included in the equity section on the balance sheet. So the income statement is linked to the balance sheet and part of the accounting equation with regards to being the detail, the breakout, telling of the story of the equity section, the activity that happened during the year to get us to the point in time that we're at this year, which is represented by the balance sheet and the accounting equation, assets equal liabilities plus equity. So then if we go to the assets, once again, we got assets that we would break out into the current assets. So category. We got a colon representing that everything underneath it will be in that subcategory of current assets. We've got cash. We've got the accounts receivable. Those two you just kind of want to memorize. They're always going to be up there starting off in the current assets. Almost every company will have cash and accounts receivable unless they don't make sales on account, unless they get paid when they do the work all the time. But if they send out invoices, they'll have cash, they'll have accounts receivable. If they have inventory, if they sell things to make revenue as opposed to doing service, then they'll have inventory on the books, which will also be a current asset. So you just kind of want to memorize where that's going to fall. Then prepaid insurance is typically, prepaid expenses are going to be things that we paid for before we got the benefit of them. Insurance is the most common example because we have to pay for insurance before we get the coverage. Therefore, we put it on the books as an asset when we pay for it. That'll typically be a current asset as well. And then we're going to sum up the current assets. If we add all these up, we're going to take it out to the outer column, that being the $92,500. Then we'll go to the fixed assets, which also could be termed property, plant, and equipment. PP&Es, the abbreviation for property, plant, and equipment, might be called depreciable assets from time to time, although land will be included in there oftentimes, which is not depreciable. It's the one thing included in there that's not depreciated because it typically lasts for a long time, more than our lifetime, right? Whereas a building depreciates or forklift, deteriorates over time. So these are going to be the long-lived type of things like the property, plant, and equipment. So forklifts, buildings, and whatnot, even if we paid cash for them, we put them on the books as an asset. Then we're going to have the less accumulated depreciation. This is a contra asset, meaning it's an asset here that's actually going to decrease the asset balance. The only time you have a contra asset is typically when you have it, it's linked to this account. Basically, we're saying, hey, look, this is the $295,000 cost, and we've allocated out $71,400 of that cost to the income statement, and we've done so with an estimate. So you would think you would just subtract, when you did that, why didn't you just lower the plant and equipment by the $71,400 if you've allocated that cost out? Why do you have this other account? Because we broke out the other account to give more information. The more information now tells the reader, look, this is how much we paid for it. This is how much of that cost has already been allocated out. This is the estimate then of the decline in value that happens over time. And therefore, the difference between these two numbers is going to be basically the book value, and that's going to be the $223,600. We could have not done that and just had the plant and equipment at the $223,600 representing the book value, but that wouldn't give us much information. It wouldn't tell the reader, hey, look, this is an estimate, and the amount of decline is an estimated number that we allocated the cost for. Okay, so then we have the total assets down below, and that's going to be then the fixed assets and the current assets. So we're just going to add up the $92,500 plus the $223,600 to get to the $316,100. Other side, we go to the liabilities. Then we typically have current liabilities. You always want to memorize that. Always going to be the case. We're going to have liabilities, then another subcategory, current liabilities, those liabilities that are going to be due within a year's time. Then we typically will almost always have accounts payable. Those are things that are going to be the normal process of operation payables. typically oftentimes related to the purchase of inventory in the normal process of operation if they sell inventory or common types of expenses. It's going to be current because it's due within a year. Note payable. Now, the note payable might not always be current, but you're typically often going to see notes payable. That's going to be a loan that you're going to be taking out. It could be current. It could be long term. It could be both. There might be a current portion and a long term portion to it, depending on the terms of the loan. If the loan is due, or any portion of it that's due in terms of the principal portion within a 12-month time period, will then be the current portion of it. Bonds payable, also going to be another type of financing. The difference between a note and a bond being that the bond is something that we might have a broader spectrum of people that we can issue a bond to, and the note we typically would take from the bank. The bond payable could be current or non-current again as well, depending on when the maturity of it will be. If it's less than 12 months, current; if more, non-current. We're going to say that, and then we're going to say that these are all current, and then total liabilities is going to be 103,800. Notice what we did not do in this situation. We didn't say, hey, look, this is total current liabilities, and then put a line right underneath it saying, and total liabilities are the same number, because that would be redundant. So we marked that it was current by saying, look, these are current liabilities, but then in the total, we just snuck in there just total liabilities instead of current liabilities, and then another one that says total liabilities. And that should hopefully indicate that these are both current liabilities and total liabilities, because there are no long-term liabilities in this case. Then we have the equity section, stockholders' equity. We have the preferred stock. That's going to be the $25,000 to the preferred stock, and that represents the ownership of remember, the preferred stock you don't really think of as like the primary owners of it, but it's the investment of the people that purchase the preferred stock, right? The investment in there. They don't have the same voting power, but they purchase the preferred stock, and so that's going to be their investment. Then we got the common stock, who we typically think of as kind of like the owners, because they typically have the voting power, although they don't get the preference of being paid first. And that's going to be the $60,000. That represents the money that the owners put in. Then we've got the paid in capital. Now remember, the paid in capital is what was paid by the owners for the common stock over and above the par value. So these two are another two accounts, kind of like these two over here, where they're linked. They're linked because we kind of broke them out for some other reason. The other reason here being that we typically want to set par value, because that helps us to see the relationship of the common stock and the par value. But when we issue the stock, we're going to issue it for however much we can get for it, right? So we're going to issue it for something over the par value, and that price could vary when we issue at different times. Therefore, we have the $60,000 and the $30,000 represents how much was invested in the company by the owners when they purchased the stock on the initial offering, or when the stock went out from the company. Then we're going to have the retained earnings, and this, of course, is the key number now that we're tying into the statement of retained earnings that we calculated up here, which includes a $29,676, which is tying into the income statement, which we calculated on the income statement. So then we got the retained earnings, and then that's going to give us the total stockholders' equity, which is the $212,300. Then the total liabilities, the $103,800 and the $212,300, is going to give us the total liabilities and stockholders' equity, the $316,100. Therefore, assets equal $316,100, as do total liabilities and stockholders' equity, $316,100. Again, our goal here, focusing in on the relationship between these accounts. Balance sheet is the accounting equation. Balance sheet is assets equal liabilities plus equity. How does the income statement tie into the balance sheet? It's part of equity because it tells the story about how we got to the retained earnings of this $97,300, which will then be seen if we go to the statement of retained earnings, which is needed because the change in retained earnings does not include just the net income, or in this case, earnings available to common stockholder, but also the dividends that were paid out. Therefore, we need the statement of retained earnings to reflect those two items. The $29,676 then ties out into the income statement up top. So here's the income statement, here's the net income minus the preferred stock dividends, gives us the $29,676, and then we're going to include the common stock dividends not in the income statement, but in the statement of retained earnings.